if I get a new client calling in, the first thing we're going to do is have an initial consultation with that client. So either myself or my production manager, Sarah Spinelli, we're going to have like a 15 to 20-minute phone call asking some basic questions to get an understanding of that client's overall situation. We put all of that information into a CRM system that we use, so we're taking notes during that call. And then when we finish that call, if that client was referred by a real estate agent, that agent will get a text message with an update that, hey, great news, we've connected with the Smith referral. They're going to be submitting an application. So then when we finish that initial consultation, we send a list of documents to the buyer that they'll need for a pre-approval. We also send them a link to submit an application online. So now they submit their app and docs online. And when that comes into our team, we're going to run their credit. We're going to review their income and asset paperwork, and we're going to give them a pre-approval letter if they're pre-approved, or we'll ask for additional paperwork if we need more documentation to figure out if they can qualify for a loan. So once we've got the paperwork that we need, then we send out that pre-approval letter, and we schedule the clients to have a 1-hour Zoom consultation with me. So in that Zoom consultation, I'm going to take them through all the steps to buy a home, what their mortgage financing options are, what the numbers look like for monthly payment and interest rate, total cash to close, all of that. And we break that down in really detailed level. And so I like to do that over Zoom because then I can share my screen and I can show numbers and I can demonstrate what I'm talking about. So client has that consultation with me. Once I finish that consultation, I'm sending the client a follow-up email with the fee worksheets we reviewed and any information they need for next steps. I'm sending a follow-up email to their real estate agent to let them know that we've connected. Here's what they need. Maybe they need closing costs. Maybe they need to stay, up to X price point. Maybe they need to reduce their down payment or increase their down payment. Whatever these numbers are, I'm sending that information to the real estate agent so that the client doesn't have to send that to them, and that the agent and I are on the same page and working as a team on behalf of our client. So then the client goes out, they're shopping for homes. They submit an offer. The real estate agent writes up a purchase contract as the offer. So they, along with the clients, depending on what their terms are for the offer, will write up a purchase agreement that's called an offer and send that to the realtor for the seller, the listing agent. And that listing agent and our buyer's agent will negotiate back and forth on behalf of their respective clients until they've agreed to terms, and then we're what we call under contract. So once you go under contract, the first thing you're going to do is write a check to the title company for what's called the earnest money deposit. Earnest money is due within 48 hours in most cases, and it's typically 1% of the purchase price, but it's a negotiable number. So if you were buying a home for $500,000, you would write a check to the title company for $5,000 up front. That $5,000 is a deposit that gets applied towards your down payment at the end of the transaction. So if you put $5,000 down up front, your total cash to close is $50,000 at the end, you would owe $45,000. During the first 10 days of the contract, that is called the inspection period. So during the inspection period, a buyer can cancel the contract for any reason. Okay, they have an opportunity to research the neighborhood, get the home inspected, spy on the neighbors, look at the schools, look at the restaurants, parks, everything that's around there. In those first 10 days, if they find anything they don't like, they can cancel the contract, get their earnest money refunded back to them, no questions asked. So one of the things the real estate agent will do, and this is what good realtors do, is they'll set the buyers up with a home inspector to get the property inspected. So a home inspector will go out to the home. They'll do a very thorough review of the physical condition of the property, and they'll write up an inspection report that they give to the buyers. Now, I always like to warn people, these inspection reports, they have a ton of items on them. And even just a nicely kept, well-maintained home is probably going to have 30 items on the inspection report. So a home inspector is going to let you know what are items to really be concerned with, what are items that would come up on any kind of inspection of any home, even a new home potentially. So the home inspector will walk the buyers through that process. The cost of that home inspection is paid for by the buyer, and the buyer will just give the inspector a credit card at the time they do the inspection. So we want that home inspection done within the first 10 days of the contract, because if it turns out that there's a major issue with the physical condition of the home, as long as that's identified in the first 10 days, buyer can cancel the contract and get a refund of their earnest money. So very important to do that in those first 10 days. At that time, going through those first 10 days, we're going to be starting the approval process for the mortgage. So we'll have disclosures for the buyers to sign with an electronic signature. We'll have the option to lock in the buyer's rate. So unless we do an upfront, what we call lock and shop program, the buyer does not lock their interest rate until they're under contract on a home. So from the time that we've done that pre-approval through the time that they go under contract on a home, depending on what market rates have done during that period of time, their interest rate could be higher or lower than what I quoted them in their initial consultation. So interest rates change every day along with the market. Any day the stock market is open, we could see a change in mortgage rates. So now the buyer's under contract, they have an option to lock the rate, which protects it from any market fluctuation during the approval process of the loan. And then from there, we go through 2 rounds of underwriting. So the first round is what we call initial underwriting. And one of our underwriters is reviewing all of the income and asset paperwork, the credit report for the buyer. We pull some back-end reports, some fraud reports, and some other reports that would show us if they had any foreclosures or short sales, those kinds of things. So the underwriter reviews that loan the first time through and issues what's called the conditional loan approval. So conditional loan approval means that the loan is approved pending some additional items, and we will let the buyers know what those items are. So my processor, she's the one who takes the file from the accepted contract all the way through closing, and she's the one who's the main point of contact for our buyers to put together the documents that are needed and requested through underwriting after that conditional loan approval. So around that time as well, we're going to order the appraisal for the loan. So an appraisal tells us what an appraiser's opinion of value is of that home. And if you're putting the minimum down on a mortgage and the home appraises for less than the purchase price, we use the lower between the purchase price and the appraised value to determine how much you can borrow. So if you're putting the minimum down and the home appraises for less than the purchase price, then you would either have to put more money down, you could cancel the contract and get a refund of your earnest money as long as you didn't waive your appraisal contingency, or you could go back to the seller and try and renegotiate the purchase price to bring that price down equal to the appraised value. So you got a few options there depending on where the appraisal comes in at. So then we've got the conditional approval, appraisal's complete. We've collected any documents requested from the underwriter, which is called conditions. Now we go back into underwriting for a second and final review. And then once we have final approval on the loan, the buyers get scheduled to sign closing paperwork. And so they'll sign all the closing documentation for the loan with the title company. They don't sign the loan docs with us. We send our loan docs to the title company. Then the title company schedules them for a signing appointment, which generally will happen at their office, or they'll set up a mobile notary to go to the client's house or to their work to sign the docs. And typically you're signing loan docs 2 to 3 days in advance of the close of escrow date. So you might sign your closing paperwork on a Wednesday, and then the transaction funds and closes on a Friday. So that whole process is about 30 days. But we're working off of whatever the closing date is on the contract. So when we get that contract, it's going to tell us what the closing date is, and we have to make sure we have the loan wrapped up and completed by that date. Otherwise, the buyer's in breach of contract. So we're always working off of the terms of the contract. But on average, that's going to be around 30 days. During that whole process, up front, before the buyer's gone under contract, if the client is referred by a real estate agent, every time we're talking to that client and helping them with their application and emailing them or calling them or texting them, the real estate agent is going to get a text message giving them an update on what the result was of our latest contact. Once we're under contract, then we do what's called Tuesday status updates. So every Tuesday, my processor sends out an email to both the real estate agents, any of their assistants and transaction coordinators, including the title company, and gives them an update on where we're at on the loan over email. And she gets this long running chain going as we go through the approval process with an update every single Tuesday. My production manager, she calls our buyers on Tuesdays and gives them a verbal update over the phone. And then I call both real estate agents and give them a verbal update over the phone. So everybody in the transaction gets a written and verbal update from my team on Tuesdays. I personally reach out to our buyers at the major milestones, so the conditional loan approval and the final loan approval, and then when we're funding their loan. So they're going to hear from me throughout the process as well, and that allows me to check in and see how things are going, see if there's anything we can improve on, make sure they're getting good communication. So that's the whole process to get through to closing. Once you close on a mortgage, first new mortgage payment will be due on the first day of the second month after closing. So mortgage payments are due on the first of the month. They have a 15-day grace period, but if you pay it after the 15th, then you get a 5% late fee. So whatever the payment is times 5%, that's how much the late fee is. And then if you were to pay the mortgage more than 30 days late, then it'll report on your credit and it'll hurt your credit score.